Good afternoon. I think I'm not alone. Okay, now that most of the presenters have done the donkey work, I think mine is to do a summary of whatever they've done, because we started in the morning with the digital infrastructure and then we went all of it. So mine is to do basically a summary of what they've done, and I'm looking at institutional voids. One of the things that we know is the basic thing that we know is mobile penetration, for example, and the digital space has actually improved in terms of helping the region, if not Kenya and Rwanda, basically, to reach the heights of financial inclusion that we've reached. At 96%, 92% formal for Rwanda and 90% for Kenya, digital space has actually helped. So, but we want to see essentially how does institutional voids actually bring into perspective the issue of inclusion and also the issue of depth. Because most of the countries have actually achieved the breadth, but have we reached the level of depth that we need? So this is where we'll dive into. I don't know the technology here. So essentially, what we are looking here is most of the countries have actually achieved high inclusion rate. But despite that, we still have almost in the Sub-Saharan Africa, almost 400 million people who are still not included. And the reason we ask ourselves is why, whereas some countries have actually achieved that high rate. We also have mobile transactions, basically, in Sub-Saharan Africa, actually transacting to almost 64 billion. And here we are talking about USD. So essentially what we are saying is a lot of transactions are going through mobile platforms. But despite all this, we have a higher percentage in terms of our exposure. We have about 30% of frauds being exposed or being reported through the mobile transaction. So the question we're asking ourselves is, are institutions really working, or do we still have voids even in the center of this growth? I wouldn't want to talk about so much about financial inclusion and how the adoption has gone through, because almost every presenter has talked about this. But in general, when we look at these countries, we are seeing an average of almost 86% from 35% were in 2010. So essentially in terms of inclusion, we are moving there. In terms of adoption, fintech adoption, because everybody is coming up with new technology, new mechanism of how we work, adoption we're also moving. And when we lead our data, we see a correlation between adoption and inclusion at almost 100%. So these things are actually moving in tandem. With the adoption of fintech, we're also moving into inclusion. So our key element is what is it that institutions are not doing for us to enable us to move to full inclusion at 100% and also move to what we call the depth of financial depth, because we're actually getting the breadth, but the depth is what we want. And so to guide us through this, we have what we call the fundamental right. What most people don't know is inclusion is actually a fundamental right. It's captured within the SDGs. It's actually captured, for example, in the Kenyan context, we have the Kenyan constitution actually enshrining the economic aspect of financial inclusion into it, although not directly. And so we're asking, how do we close the gap first of the 400 million people who are still there? And how do we look at the financial, the institutional voids that are actually existing? And to guide us through this is when we look at financial inclusion and financial depth, we also need to look at what institutional voids actually mean. And when we look at institutional voids, we are looking at three elements. We are looking at effectiveness, we are looking at efficiency, and we are looking at reliability. So in terms of effectiveness, if you look at these three countries mainly, you find, for example, Rwanda is very effective in terms of reliability, but it has thin markets. But because the government of Rwanda really kind of pushes things to be done the correct way. Whereas in Kenya, we are reaching almost the element of reaching 100%, but in terms of reliability, we are not there. But when you look at South Africa, and we will see in the charts to come later, They are very deep markets, but in terms of how we look at the last mile, they have not yet there. So this is just a representative of the, not really a good representative of the Sub-Saharan Africa, but what you are saying is we do not have one close-knit, for example, country or element that can actually capture all the three things. So in terms of literature review, what we looked at is we looked at mainly the theory by Hanna and Palepu. This is the theory of emerging markets. And we wanted to look at mainly how do we guide or how do we look at elements that actually bring about the institutional voids. And the institutional voids basically means the lack of or very minimal markets where buyers and sellers are actually not meeting. And why do we have these cases in place? So we have four elements. We have the fintech voids, and we have those who are basically the optimists who think, yes, the elements of mobile money or fintech will actually bring us closer to inclusion and will also bring us closer to the depth of finance. And we have the critics who say, actually, with the growth in fintech and with the growth of all these elements, then we create more problems. And does institutions have the capacity to cater for these problems? And basically, that is the void that we want to see in this research. So we have three objectives. First is to see how the extent to which voids or institutional voids are affecting financial inclusion and breadth. And also, we want to see how the mobile penetration is actually helping us in terms of achieving this. And the third one basically is on the issue of depth. Are we reaching the depth that we need in terms of when we use fintechs and when we involved mobile technology? So this is the theory that basically guides us, the Hanna and Palepu institutional voids theory, the constraint that is actually being faced by most organizations. And here we are looking at financial institutions, be it the banks, be it the microfinance, be it the SACCOs. And the key thing that we want to look at is, does the voids actually sort the issue, or does it actually now raise the marginal effect in terms of the financial inclusion and the depth? So in terms of data, we looked at data from 2010 to 2024, basically, and we are looking at financial inclusion and financial fintech adoption as our two main elements. And our key regressor is basically the institutional void, and we want also to look at the issue of mobile penetration. Of course, the other elements basically are just what we call the control variables, but we're not going to go into details of the econometric models. And basically, our frontier market is the SSA. But again, we looked at 9 countries that are actually very well included to see how the data will move or will actually be different from the rest of the Sub-Saharan Africa. So that's our empirical model. We have 3 models that we used, but this is in the paper. But our main key model is the system GMM by Orlando and Bond. So I want to go into details. The main variable that we want to look at is the institutional void actually affected by the mobile money or mobile penetration? Does it actually enhance or does it reduce the effect of institutional mob in terms of financial inclusion and fintech adoption? So this is the reason basically why I use the system GMM in terms of looking at how the dependence factor, because necessarily if you are almost included, there's no way that unless your population is increasing faster than your inclusion mechanism, there's no way you'll be included at 90% and then next year you're actually included at 86%. So basically that's why we use this mechanism, this model, to see how effects are changing. I think the font is very small for me, so I will refer to my notes. So in terms of the results, basically what we are looking at is we are seeing voids actually being a hindrance to financial inclusion. And why we say this is because without mobile penetration, for example, and without fintech, we are seeing voids in institutions. And for us, voids is the absence of proper mechanism within an institution to effect financial inclusion. So in terms of voids, we are seeing for financial inclusion, we are seeing almost a negative 3.94. basically in terms of percentage points, we are saying that voids will affect inclusion by that margin, almost 45% in terms of broader inclusion. But in terms of fintech adoption, again, that is less. But when mobile penetration now comes in, we are seeing a premium of almost 49%. So basically, in terms of how mobile penetration is helping institutions with their voids is about 50%. So mobile penetration and fintech adoption and basically the systems coming in, we are helping our institutions, being the banking sector, by almost 50%. And that's the key elements that we want to bring into this research. But when we look at it in terms of what we're calling the bricolage factor, so the bricolage is how does mobile penetration help the entire of Sub-Saharan Africa actually improve in terms of inclusion? It is a key factor. So it means that institutions and countries have to actually enable or provide infrastructure that most of the presenters have talked about in terms of how to improve our infrastructure and how to include all these elements into the financial aspect. So when we move to the next element, when we look at the 9 countries, we see there's a greater improvement in terms of how we're looking at mobile factor and financial inclusion. But when you look at the 9 countries, what we're calling the advanced countries in financial inclusion, mobile penetration is not really an issue because it's actually, if you look at the financial inclusion, it's actually not even significant. For countries like Kenya, countries like Rwanda, mobile penetration will not really help in terms of financial inclusion because we already reached that peak. So what next do we need to do? And you say country like, for example, for fintech adoption, as much as it's moved from 0.33 to 0.45, it does not mean that is actually there's a risk, but it means that even these countries that have already developed, it means that we have an issue that the institutional voids were carried over, so which needs actually to be improved with time. So basically that's what the results means for the 9 countries. And if I could go ahead with just 2 minutes of addition, what this tells us is for account ownership, for example, the whole of Sub-Saharan Africa was 64, but in terms of the 9 countries which are ahead, we're actually at 79. And when it comes to mobile user, we're almost at 100%. So basically meaning that for the developed countries, mobile penetration and fintech adoption is not an issue. An issue should stop somewhere else. And if I could move to this, just to go faster, especially what I've been talking about, you could see the blue line and the dark blue line, basically meaning financial adoption and financial inclusion are moving together. But if you look at the red line, which is almost flat, and that's what we are talking about, the financial depth, we see the gap is very big. So for the Sub-Saharan Africa, meaning we are concentrating on inclusion, but we are not concentrating so much in terms of depth, and which is the key thing, and which my predecessor just talked about, impact. It's not being felt. If you look at the 9 countries, the same gap happens, but the gap is smaller. Because initially it was around 31%, but here we are talking about in terms of, it was around 23%, but here we are talking about 31, 33%. But if you look at countries that are well endowed in terms of depth, like South Africa, depth is around 90%, Cabo Verde around 56%. If you remove those 3 countries in terms of depth, then we are saying the entire of Sub-Saharan Africa is the same. We are not doing much in terms of depth. We are concentrating on the breadth in terms of financial inclusion, but we are not doing much in terms of depth and where the impact is actually being felt. So what are we saying in terms of these elements? We are saying that we need to concentrate on a few things, and which my predecessors have also talked about. We need to look at product differentiation, and Flora just talked about how we look at women, how we look at youth, and how we look at the rural places. So these are things that we actually need to concentrate on, product differentiation. We also need to look at costs of transacting, and basically how do we move from now concentrating access and actually creating more room for depth, and how the credit facilities will actually help everyone. So I'll stop there. These are the things that I was talking about in terms of market, products, and actually banking reliability. basically with the things that are actually missing currently in the banking sector or in the financial institutions. So I want to stop here, but I've provided an overview in terms of future research, because again, we were using data from World Bank, and basically, which is aggregated. Probably we need to go dig deeper and look at maybe financial institutions themselves, how voids in each sector or in each bank is actually being affected. Thank you so much.
Thank you. Thank you, Mr. Casper. Do we have any contribution from the floor? Seems like everyone is in agreement, and your presentation was as clear as possible. Yes, we do have one who's going. Oh, there's the microphone.
Yeah, thank you, Casper. We cannot be entirely in agreement. There are some things that you probably need to clarify.
Sure.
I think first is the connection between what you're calling institutional void and innovation. So innovation is typically seen from the context of technology. But the dimension that you bring out in the paper is that there is potentially innovation that could come from the dimension of institutions themselves. Are there any specific aspects from an institutional setup that require innovation? So then you stretch the definition of innovation to go beyond technology. And talking about institutional void, could you probably shed some light as to which dimensions of institutions are you seeing that void manifesting itself in? Are you seeing a situation where you have weak institutions? Are you seeing a situation where you have missing institutions? Or what exactly does that void mean? Because that's the extent of your study. And then finally, when it comes to your idea of innovation, there are two ways I can look at innovation, and perhaps we've touched base on this. The first one is doing things that you've been doing all the time, but doing them differently, more efficiently and more effectively. But you can also do innovation by way of doing things that you never used to do previously. So which dimension of that fits into the framework that you're bringing in the paper? Thank you.
Okay, thank you, Jared. I think in one of my slides, maybe I could have jumped it. I think one of the slides, if you could show on slide number 16. Essentially, I tried to capture this into two, where we are talking about in terms of efficiency innovation and market creating innovation. So in terms of, for example, a country like South Africa where the depth is actually high, then we are talking in terms of efficiently being innovated, and where they've digitized most of their banking systems, and market creating innovation for a country like Kenya where we have M-Pesa and all those kind of things. So, but just to speak about in terms of the institutional voids. Now, in this paper, the institutional voids that I used the inverted WGI indicators, which is institutional governance, because institutional governance gives us the quality of the institutions. So the opposite of that is what we will basically call a void, because if institutionally your quality is 60%, then you have a void of 40% that you need to cover. So this is the one that I actually used in terms of to cover, because we do not have a specific measurement of institutional voids. And again, this is on aggregated data for a country, but that's why I'm saying my study now has suggested that we need now to have institutional voids for each institution, for example, the banks or financial institution, to actually come up with the voids that are actually specific to the industry and not specific generally, because that's how we have captured the institutional voids. In terms of innovation, again, innovation is broad. We are looking at, in terms of innovation, in terms of mobile penetration. That's the term we used. And we're looking at how the mobile penetration, for example, is coming to fill these voids. For a bank, for example, that does not have mobile connectivity, then it means their customers must go to the bank, must go to the branch if they don't have mobile. But for example, most circles, for example, which are starting up, you'll find they do not have connection to mobile. So it means basically their customers have to go to the branch or they have to go to that particular bank to access to products. So this is where now the mobile penetration comes in to fill that gap. And that's the void that we're actually talking about. Thank you.